Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. Restaurants are again teaming up with diners, airports with flyers, and markets with life. More and more people are now stepping out and loosening their purse strings, breathing new life into pandemic-ravaged sectors. The central government too has asked all states to relax or do away with additional restrictions as the active cases hovered close to 250,000. So how is India's economic recovery shaping up now? Our next report tells us more.
The Union Finance Ministry, in its latest monthly economic review, said that the third wave of the pandemic reached the peak in just 31 days, thereby limiting the damage to the economy. The second wave lasted about 79 days and the first 220 days. Of the three, the third wave has also been the least fatal. Demand for energy also remained resilient as power consumption in January this year grew 2.1% over December, reflecting the weak impact of Omicron on economic activity. As the danger of the fast-spreading Omicron variant subsides, major hospitals across India are reporting almost empty COVID wards. Daily COVID-19 cases have trickled down from a high of 3.47 lakh on January 20 to 25,920 on February 18th, while daily recoveries continue to outnumber new cases. 78% of the adult population is fully vaccinated now. With that, and following the centre's fresh order, states have started to remove the additional restrictions imposed in the wake of the third wave. While Haryana lifted all such restrictions last week, several other states including Maharashtra, Delhi, Gujarat and Kerala are expected to hold review meetings soon to take a call on the matter. States are going for a gradual easing of restrictions. Gujarat relaxed the night curfew timings by 3 hours last week. Delhi, which still continues with night curfew and curtailed business hours for shops, is likely to revisit its stance this week. It has already lifted the weekend curfew. The odd-even system of opening non-essential shops has also been done away with. Multiplexes have also been opened with half the strength. In Tamil Nadu, nursery and play schools have been opened, putting the entire education sector on track. The state government also allowed 100% occupancy in almost all previously regulated places, including theatres, hotels, malls, gyms, shops and amusement parks. The state had already lifted night curfew through notification on January 27th. Kerala, still with a positivity rate of 15.75%, is going slow, withdrawing restrictions in stages. While states are doing their part to aid in the economic recovery, the centre has considerably relaxed the restrictions on international travellers last Thursday. Fully vaccinated passengers from 82 countries will not be required to take a pre-departure RT-PCR test. International travellers will not have to mandatorily home quarantine for 7 days or get an RT-PCR test done on the 8th day. The government has also removed the demarcation of countries at risk and other countries. With this, the requirement of giving samples at airports and waiting till the result is obtained from countries at risk is done away with. The ban on regular international flights, which has been in place in India since March 23, 2020, was extended to February 28th. However, special passenger flights have been operating between India and approximately 40 countries since July 2020 under air bubble arrangements formed with them. The government is reportedly planning to lift the suspension on scheduled international flights from March. Meanwhile, India's domestic air passenger traffic fell sharply by 43% in January to 64.1 lakh passengers from 1.1 crore passengers in December. Air passenger traffic was enjoying a rebound after the second wave, but was dented by the third wave in January. Almost 90 lakh passengers took to the skies in October, 70.7 lakh in September. The recovery in aviation has been bleak so far, with the industry struggling to reach pre-COVID levels. However, reducing travel constraints and infections is expected to help in air travel demand.
The third wave, which about started in the end of December, disrupted the New Year celebrations, disrupted the December revenues, which almost were formed 10% of the annual revenues for the hospitality industry, really put the industry into a corner once again in the third wave. In fact, third time over. Come February, I think there is, by the 15th of February, the revenue restoration has almost reached about 40 to 50% across all cities in the country, up to about 60% in some of the places like Mumbai and Delhi. However, hotels continue to suffer because of lack of international travel and tourism happening, and out of some 125 countries, there are only bubble arrangements with about 25 only right now. And most importantly, what is affecting the hotel industry is the continuing cap on social gatherings. So therefore, even weddings and events have taken a big hit. So the Omicron fading away soon is a welcome news, but the industry is taking a very guarded approach.
Meanwhile, the government and the RBI have sounded optimistic notes about the economic recovery. The finance ministry said that overall economic activity has remained resilient amid the third wave. Citing high-frequency indicators, its monthly economic review said that India's economy is well on its way to growing at above 9% as projected in the country's advanced estimates for the current year. It also said that agriculture continues to see a constant increase in net sown area and crop diversification will strengthen food buffers while benefiting farmers through generous volumes of procurement at remunerative minimum support prices and income transfers. The report claimed that the budget 2022-23 has strengthened the direction set for India's economy by the previous year's budget. The ministry is hopeful that employment generation by the government's capex push will lead to an increase in consumption levels.
But there are some sectors which thrived during pandemic. Quick commerce is one of them. In an interview with Business Standard's Surajit Das Gupta, leading quick commerce player Dunzo CEO Kabeer Biswas tells about his latest funding round in which Reliance Industries picked up 25.8% stake in the firm. Biswas also shares his long-term expansion plan. Let's listen into the interview.
Thank you for being in the morning show. Generally, startups go and in various rounds go to private equity funds to go for their next valuation and their next raising of money. You have done something which is very different. You have gone to a large company which is also a major player in the retail space. So what was the reason?
The way we think about this business is I think we are building a new format of retail over the next 10 to 15 years, where I think consumerism is only getting quicker for a lot of customers. Everybody wants stuff delivered to them a lot faster. And I think one of the best conversations that we have had over the last couple of years' time has been with the Reliance retail team, which was able to not only go ahead and paint a picture of the way they see the world, and I think there were a lot of synergies in terms of how we were seeing the world and how they were seeing the world. I think the interesting parts were also where suddenly with this strategic partnership, I think over the next 5 to 10 years time, the size of business that we were planning to build, right, most likely goes ahead and doubles because of this relationship. Because there are multiple facets to it. The first one really is in all the cities in the country, we suddenly can go ahead and run on top of the existing Reliance retail supply chain. And make sure that customers get what they want on a daily and a weekly basis, delivered to them within 15 to 20 minutes time. And I think that existing supply chain allows us to go ahead and start becoming more efficient in every city that we launch right at the top itself. The second one was, of course, I think we can also partner with them on their omni-channel play. We will work with more financial investors, over the next 5 years time, but at this time and scale, I think it was important for us to be able to work with somebody with whom we could go see a common 5 to 10 year horizon.
What is the number of SKUs will you have in this? Because to me, the issue is that the SKU is very limited to a certain amount of products and you don't get. And the other thing one sees is that you do not get the kind of discounts which you would have got if you would have waited for maybe not 15 minutes, but end of the day or next day.
I think the SKUs that we will stock will be anywhere from about 2,500 to 3,000 odd SKUs. We also keep running a lot of experiments, Surajit sir, where I think we get to learn about customer behavior. Like, for example, right now we are running something around Valentine's Day to be able to say as to, again, I think consumer behavior is getting to be extremely instant. And so on a day like Valentine's Day, how can we go out and get customers things that they want instantly delivered to them? Similarly, we are looking forward to Makar Sankranti. And so the number of festivals, etc., that exist in India, you are able to go ahead and tune your selection based upon what customers want. I think the idea is to not be able to offer a hypermarket kind of what you call selection, because that is never going to get profitable in this form factor. The only way to get profitable is by going ahead and making sure that you have a very sharp selection that customers go ahead and buy very frequently with you. I think we have looked at customer behavior, looked at search data. We have gone ahead and looked at customers entirely what they buy in a month in their households, right? What we have realized is there is a big 80-20 Pareto, where about 20% of SKUs end up causing 80% of the GMV. Or the what you call share of wallet with our customers. And so what we are shooting for is we're shooting for those 20% of SKUs that we will go ahead and make sure are in these warehouses available all the time. And people can buy and get them delivered in 15 to 20 minutes time. This category, I'll be honest, Surajit sir, is going to get created out of convenience and not necessarily discounts. It's the same reason why you were buying from your local mom and pop store. You weren't buying from them because of discounts. You were buying from them because of convenience, because of this 30 to 45 minute commerce category that they would go ahead and fulfill. So either you call them up and they would deliver it in 60 minutes time, or you would go there, or you would send somebody from the house and you would get that in 30, 45 minutes time. That transaction was never discount led. That transaction was always convenience led.
You had earlier talked about going for an IPO and taking the company public to raise funds. So how is that moving for you now?
Cool. So our IPO plans are really only in 24, not anytime before that, right? What you will see us, you'll see us raise capital from the private markets and the PE investors that you spoke about before this over the next 3 to 6 months time itself. And that will go ahead and make sure that, we can go ahead and become the number one player in this category in the country over the next 18 to 24 months time. Once we become number one and at what you call over a couple of $1 billion of GMV scale, at that point of time, really in 2024 is when we want to go ahead and start looking at how we can go ahead and become public.
So if you look at your model, the GMV division will be what? From the quick service business and from the other your B2B business, what is the kind of ratio that you're looking at? And do you think it will eventually become a B2C platform and the B2B business will sort of slowly become smaller and smaller?
So I think as a split of GMV, today we are at about 70% from our 80% from our B2C business and 20% from our B2B business. What we are realizing is that the B2C business is growing much faster. It's the nature of it because we are able to go ahead and market it a lot more aggressively. We believe that over the next 24 months time, we'll be 90% B2C and 10% B2B. It's also got to do with the nature of the transaction. Every B2C transaction is worth about 400 rupees. And every B2B transaction is worth about 60 rupees. So when you look at revenue split, the B2C one tends to become a lot bigger, much faster. So think of us right now as a business that is entirely focused on our B2C business and is incubating our B2B business.
Wonderful talking to you.
Likewise. Thank you so much.
Thank you.
After Dunzo, let's move on to the market, which was on the edge last week due to the standoff between Russia and Ukraine. The broader markets fell up to 3% during the week, while benchmarks dipped 0.5%. Yet about 9 stocks have surged over 15% so far in February on the back of aggressive volume support. Our next report analyzes these stocks and also outlines market strategy for the week ahead.
The week gone by was nothing short of a roller coaster ride for equity investors. From a 3% downtick in a single day to rallying 3% the next day, the Ukraine-Russia standoff in Eastern Europe resulted in wild swings on the bourses all through the week. Overall, the benchmark S&P BSE Sensex and the Nifty 50 closed with meager losses of 0.5% each after Russia reportedly withdrew some troops across the Ukrainian border. In the broader market, the BSE Mid-Cap Index fell 1.9%, while BSE Small Cap Index shed 3.2%. However, what has emerged as a notable trend in the current month is that investors, globally and in India, are adopting a risk-off approach and are looking for strategies to minimize losses amid choppy markets. While Dow Jones has corrected 4% and Nasdaq has dropped 5% thus in February, the frontline S&P BSE Sensex and the Nifty 50 have gained around 0.25% and 0.2% respectively. Despite this, there are 9 stocks that gained between 15 and 20% in February. Of these 4 counters, Blue Star, RHI Magnesia India, Schneider Electric Infrastructure, and LG Equipment soared 20% during this period, data show. Let us go to Business Standard's Avdut Bakkar to understand the reason behind such massive outperformance by these stocks and if they have any upside left.
The current international situation could not have any negativity on these 9 stocks. These stocks list includes BSE, Blue Star, LG Equipment, RHI Magnesia, Schneider, and few others. The major reason for these stocks that they could perform better are the significant improvement in their chart setup. An improvement in candlestick formation, chart patterns, and aggression in volumes, gap up situation entering into new territory have helped these 9 stocks to stay afloat in this current scenario. Stocks like RHI Magnesia, which claim a new all-time high, followed by stock like Blue Star, which claim a new 52 weeks, generated a positive sentiments among bulls. Similarly, BSE and Vedanta have built up on a robust candlestick formations that could help traders and investors to protect their support levels. Other stocks like one could say LG Equipment, which has seen a formation of higher high, higher low, a chart pattern that induces positivity among traders. In terms of Schneider, one could see a strong gap up supported by volumes developing interest among the market participants.
This week, analysts expect volatility to continue in line with global peers as the geopolitical uncertainty, volatile crude oil prices, and monthly F&O expiry are likely to weigh on the market sentiment. Besides, there are hosts of other events lined up in the next few weeks in the form of the big-ticket LIC IPO, the assembly election, and the implementation of the new margin system, which will lend incremental volatility to the markets. We spoke to Ajit Mishra, VP Research at Religare Broking, to understand the market strategy for this week.
So this week we expect market to focus more on this prevailing geopolitical tension between Russia and Ukraine in absence of any major domestic event. And any news of de-escalation would definitely lift the market sentiment and help the index to inch higher. And in case of any negative surprise, the reaction would be equally severe. So keeping that in mind, plus we have the monthly expiry also, so that would add to the volatility. So keeping all in mind, it's prudent that one should stick with the hedge position and stick with the index majors instead of mid cap and small cap.
Meanwhile, Milind Muchala, who is Executive Director at Julius Baer, says, these interim corrections can present a good opportunity to gradually build up on the equity exposure as we continue to believe that the earnings momentum will remain a key support for the market. Our preferred sectors include domestic cyclicals such as financials, industrials and infra, building, material and auto, while we would also be positively biased on consumption, especially discretionary, healthcare, IT on corrections, and select names on bottom-up basis. Technically, the 50-share Nifty is expected to move within 16,750 and 17,620 zone with support placed at 16,920. The Sensex index, meanwhile, will seek support at 57,000 level and could trade in the range of 56,450 and 59,150.
After the markets, let's move on to the automobile sector. Like airplanes, vehicles too have their own version of black box which monitors driving habits, vehicle usage and distances covered. They're called telematics. World over, insurance companies and taxi owners use it to track the vehicle. In India, an IRDA panel in 2019 proposed the implementation of telematics insurance. Data from this device can be used to calculate a premium or in-service like the accident alert and theft recovery. Our next report tells more about it.
Telematics is a technology that combines telecommunications, informatics, and wireless devices to send, receive, and store data connected with vehicles. Telematics devices collect and transmit location using GPS and other vehicle-specific data through cellular networks or satellite communication to a centralized server. This data is processed and stored in a user-friendly format that can be accessed by fleet owners via websites and apps. The most common application of telematics is in the logistics and transportation industry, especially in commercial fleet vehicles. The data captured using telematics devices can include location, speed, engine idling, harsh braking or acceleration, fuel consumption, temperature, and vehicle faults, among other things. This enables fleet owners to effectively monitor all their vehicles collectively and individually in real time. Fleet management software can read this data to send alerts to fleet owners on performance issues, emergencies, and critical events like route deviation or overspeeding so that swift action can be taken. Vehicle maintenance can be improved and made predictable as sensors identify when to change oil, brake pads, or batteries. Based on telematics data, fleet managers can also gain insights into driving habits and patterns, which can in turn help them create training programs to improve driver safety. The technology can help boost productivity, save costs, and thereby increase profitability for fleet owners. Telematics also helps insurance companies underwrite premiums. Insurers can build a risk profile of the customer based on their usage of the car and charge premiums accordingly. Information on the average speeds at which a car is being driven, the distance covered on a daily or periodic basis, and driving skills can support the insurer's decisions. According to a report by Fortune Business Insights, the global commercial telematics market size was $34.79 billion in 2020. The market is projected to grow from $40.18 billion in 2021 to $158.31 billion in 2028 at a compound annual growth rate of 21.6% in the 2021 to 2028 period.
In Britain, over 10 years of data obtained from telematics boxes busted several myths, including the most popular one that men are better drivers than women. The data confirmed that women drove more carefully, at lower speeds, and were involved in less accidents than men. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.